Good afternoon, everyone. This is Abid Khan, and you are watching Karachians Academy YouTube channel. We are doing CIE past papers, and we have selected AS level accounting past paper 9706, paper 1 and its version 2, and we have selected year 2022, its latest attempt, May June. So we have done question till question number 7. We will do question 8 now. Now please move on to question number 8. So we did this question 7. What is question number 8? At the year end, Victor had 100 units of inventory which had cost $12 per unit. This is cost per unit. Of these, 8 units had been received on the last day. 8 units on last day of the year and had not been paid for. You know, we are maintaining actually sometimes examiner gives some tricky questions, and most of the students get confused. So you should not get confused, because we do not maintain our books of account on cash basis, right? We maintain on accrual basis. So we have bought the inventory, either it has paid or not, it is no matter. We will record it because we are recording based on accrual system. So he's just confusing you that it was not paid. Some of the students will deduct these 8 units from total of 100 units. So it has nothing. You don't pay attention to this one. An additional 6 units were damaged. Yeah, this we have to consider, and would be sold for 10. This is sales price of these damaged units. This is your cost price and this is sales price, right? The damaged unit you can sell in 10 per unit once repairs to them, but one thing is there, you have to repair those damaged units. Totaling $20 were made, right? What was the value of inventory in Victor's financial statements at the end of the year? Okay, we know International Accounting Standard 2, IAS 2, which very clearly guide us that at the time of valuation of inventory, or when you are recording your inventory in financial statements, always take lower of cost or net realizable value. So this concept you have to keep in mind. Right now, move on and we will see how we will solve this. Remember one thing, this is MCQ based, so simply you have to do calculation for yourself. So you can show your calculations, no issue. So this is some sort of a working I want to do here. You can say working 1 or working 2, whatever. So what is there? The cost of 100. So you have to tell us what is the correct inventory value that should appear in your financial statements. And I have explained you International Accounting Standard 2. So cost of 100 unit, and what is your cost? It is 12. So this is $1,200. This is cost of 100 unit. Out of this, these 6 units are damaged. Then you should deduct them. Damaged units. We will treat them separately. So how much is the cost of damaged units? Damaged units are 6. So this will be 6 into 12 is per unit cost. So $72 you have to deduct. Now how much is cost? Let me have my calculator. $1,200 was total cost. Here the damage cost of the damaged unit we will deduct. Now this is the cost of good units. They are good units. Now you have these 6 units you have to calculate, and we have to consider cost or net realizable value, whichever is less. So if we calculate its NRV, how much it would be? NRV of 6 units. This will be 6 unit into 10. This is the sales price. Sales price. The sales price is 60. Okay. So repairing is total 20. So it is how much? 60 and 20 and then 40. 40 is basically NRV, right? So 6 unit NRV is 40, right? And its cost is 72. So whichever you have to consider. So lower of cost or NRV. The lower of cost and NRV 72 and 40. So 6 unit cost you have to take at 40. So this will be your 1128 plus 40, 1168. This will be your ending inventory, which you will consider during preparation of your financial statement. So your answer will be C, 1168. Move on to question number next question. Next question is 9. Which items are treated as expense in the income statement? Okay. Accrued expenses at the end of the year, they are expense and we record them. Means expenses debit and accrued expense credit, right? They are to be paid. So accrued expenses are to be charged to. So this is one thing clear, that they will be charged to income statement, right? Prepaid telephone charges at the end of the year. So this is prepayment. So this is a balance sheet items. This will not be charged to. This will not be charged to income and statement. Increase in provision for doubtful debt. So whatever the amount of increase in that is regarded as, and we consider it as doubtful debts expense or bad debt expense. The increase in provision. So bad debt expense is charged to P&L, right? So this will be charged to P&L. So these two items will be charged to P&L, and this prepaid will not be charged. Now we see it has given you different options. This is correct, right? This is correct. This is not correct. This is wrong. So based on this, you should avoid this option 1, right? Increase in this is wrong and this is also wrong. Now see, this is wrong because he's saying not to be charged. No, this will be charged. And what is say this is wrong. This is correct. So this whole is incorrect. C, charged to P&L, yes, this is correct. And not charged to P&L, yes, this is correct. And charged to P&L, yes, this is correct. So this option C is correct. So your answer is option D. Sorry, and answer is option C. Move on to next question. Question 10. What question 10 says? At 31st December 2021, the draft statement of financial position. Okay, this is draft and this is ending year. Statement of financial position for a business showed total assets of 1 million, right? Total assets of 1 million. Okay, the following was then discovered. An increase in the provision of doubtful debts 5,000 had not been recorded. Okay, what was the corrected total assets value? This is the requirement. It means this 1 million total assets, they are draft and they have some missing information. So we will incorporate them. So the draft assets are, or I can start this from here. $1 million, right? An increase in the provision of the doubtful debt. When the doubtful debts are increased, we normally make entry of bad debt expense or P&L, whatever you say, expense, debit, and allowance for bad debt credit. And this allowance for bad debt is deducted from your receivables. So the increase in allowance for bad debt will decrease your assets. So this will decrease your total assets. So how much? It is 5,000. So you have to deduct it, right? Now see what is else. Closing inventory had been overvalued by 20,000. So closing inventory overvalued. So means your current assets have been increased. Means your assets are increased. So you have to deduct them. Right, and depreciation 10,000 had not been recorded. So again, depreciation we call depreciation expense debit 10,000, and we credit accumulated depreciation, and this accumulated depreciation is basically deducted from the gross assets to come on the net assets. So you have not deducted this, now you have to deduct. Right? So how much would be 1 million minus 5,000? $1 million minus 5,000 minus 20,000 and minus 10,000 is 35,000. Pardon, just 1 minute. This is 1 million minus, you have to deduct 5,000, then you have to deduct 20 and 10, 30,000. 9 lakh and 65,000. 9,65,000. This will be your corrected total assets. So your answer will be 965. So answer will be A. Your answer will be A. Okay, guys, thank you very much, and that's for all today. That's all for today. So we'll see you in the next video with question number 11 and onward. Thank you very much, and bye for now.